Okay, in this next video, I want to go through a couple of examples with you using the savings and investment model. We'll change a couple of exogenous variables and see what happens to the endogenous variables. So the first one here is, say, an increase in autonomous consumption. So on the consumption function, remember that is consumption is equal to autonomous consumption plus some function of disposable income and the real interest rate. So autonomous consumption is that y-intercept on the consumption function, and it includes anything else that's not disposable income or interest rate. So let's see what happens in this model. First, let's draw the model. We've got real interest rate here. We've got a savings function, an investment function, and down here will be the quantity of savings and investment. So the quantity of savings and investment. I write quantity there so you don't confuse it with S up here, which is S for the savings function. So this line here is a savings function, different than the quantity, and here is the investment function. So we've got an equilibrium here. Savings is equal to investment, and an equilibrium real rate. And we've got, for whatever reason, autonomous consumption increases. Maybe it's because the stock market went up and people are a bit wealthier and start spending more money. Maybe because his wealth has gone up or whatever, they've decided they want to start spending more money at the same level of income. Okay, so what's going to happen here? Well, the savings is equal to Y minus C minus G. Total savings, which remember is private savings plus government savings. So autonomous consumption goes up. That means consumption's going to go up. So this variable here in the savings function, C, goes up. So what's going to happen to that savings function, the line, the curve? It's going to shift to the left. So this, we call S prime, the new savings function. The change in consumption isn't going to affect investment, because remember, investment is autonomous investment plus some function of the real interest rate. And we can see here on the graph, there's going to be a new equilibrium right here at a higher interest rate and a lower level of savings and investment. So the quantity of savings and investment is going to fall. The real interest rate is going to rise. So the endogenous variables here, endogenous variables are R, the real interest rate, and that increases. The quantity of savings and investment, those are endogenous, they decrease. And the fourth endogenous variable is consumption. And we already figured out that increases. Now this is what happens in the long run in this model, because this is a long run model. In the short run, something different might happen. You know, in the short run, we know that y equals C plus I plus G plus NX, total expenditures. In the short run, if total expenditures go up, output will go up too. But that's in the short run. In the long run, output is at potential. So if we look at the PPF, right there on the edge of the PPF, that's the long run level of output, which is determined by the production function, technology and physical capital and labor. So what would happen here, looking at this, if we were, say, at this red point here on the PPF, and consumption increased, down here, this is consumption, this is investment, new capital goods. If consumption started to increase, that means we would move to a different point on the PPF, where we have a little bit higher level of consumption. And a little bit higher level of consumption means a lower level of savings. At least private savings is going to fall. Here we're holding G and T constant, so that means public savings isn't going to change. So savings and investment is going to fall. You can see it on the graph here. Consumption goes up, investment here is going to fall. And the interest rate is going to change a little bit. R is going to go up because there'll be some movement on these curves too. As the interest rate goes up, savings goes down. There's a movement along this investment function here to the new equilibrium. Say investment spending is going down because the interest rate is going up. Okay, let's go to the next model. Or next example. Okay, this next example is an increase in government spending. So let's bring the government in here. So G is going to go up. And let's say taxes don't change at all. So without any change in taxes, without T changing. Now let's see what's going to happen in this model. So we'll draw the model here. So the quantity of savings and investment is down on the horizontal axis. The real interest rate is on the vertical axis. We've got the savings function, the investment function. And let's see what happens. The savings function here is y minus c minus g. The investment function is I bar plus some function of the real interest rate. If g goes up, that means that this variable here, g increases, y is fixed. So as g increases, we're going to have the savings function shift to the left. S prime. There's less left over for savings. So we can see on here the new equilibrium. It's pretty easy to see what happens to most of these endogenous variables. Savings and investment are going to fall. So S and I fall. Now that's total savings falls. And R, the real interest rate, increases. Well, what about consumption? What happens to consumption here? Well, remember, consumption is equal to A bar plus some function of disposable income and the real interest rate. We can see that the real interest rate is going to rise a little bit here on our graph. which means that consumption is going to change a little bit. Real interest rate goes up at equilibrium, which means consumption is going to fall a little bit, because consumption mainly changes because of income, but the interest rate will affect it. So consumption will fall a little bit. Not as much as the change in government spending, though. They're not going to wash each other out. So over here we have consumption will fall. So we know total savings falls. But remember, total savings is private savings plus government savings. So we have government savings and we have private savings. Are they going to do something different? Well, government savings is T minus G, defined that way. So if G goes up, that means that the government savings goes down. So this part goes down. Well, what about private savings? What happens there? It's a little harder to figure out. Private savings is Y minus T minus C. Y and T aren't changing, but C is dropping a little bit. That means that private savings actually has to go up. Total savings is falling here, but private savings is actually going up. And that's because the government savings is going down more than private savings is going up. So remember, consumption is only falling because the interest rate is going up. There's no G in the consumption function here. And that means as the interest rate goes up and consumption falls a little bit, savings goes up by the same amount. The consumption fell. So the most difficult part of this problem is realizing that even though total savings is falling, private savings is actually increasing a little bit. That's because of these change in interest rates. Consumption is falling just a little bit because of the higher interest rate, and it's making savings go up a little bit more just because of the higher interest rate. And notice that the G here is not in the consumption function. Now, Ricardian equivalence. This is an idea by Ricardo. And his idea is that government spending really has no effect in the economy, because if the government starts spending more money, people are going to be thinking to themselves, the government's spending more money, they're going to eventually be increasing taxes to pay for it. So we better start saving now and spending less so we can pay the taxes in the future. So if we have an economy here that C equals C plus I plus G, we'll have a closed economy, won't include exports. Ricardo's thinking G goes up, consumption is going to fall by the exact same amount. So it won't affect income in the short run because of people changing their consumption function. Essentially, G goes up and autonomous consumption falls by exactly the same amount to offset the increase in G. Now in this model, what we have here that we went through does not show Ricardian equivalence. This shows that if what happens to government spending, and this output is not going to be affected in the long run, but that savings and investment will fall in the long run, and consumption might fall a little bit, but it's only because of the higher interest rates, and it's not enough to match the increase in government spending. So we would not see Ricardian equivalence, at least in the model that we did. If there was Ricardian equivalence going on in the economy, if consumers really did that, if they stopped spending because they thought, oh, we're going to have to be paying more taxes in the future, then it would also affect that the consumption function. It would affect autonomous consumption. And then autonomous would fall and consumption would fall by the same amount as G, and then the graphs wouldn't change at all. We'd have the same equilibrium point. Now, is there crowding out? Crowding out is this idea that government spending crowds out private investment. So as government spending increases, investment spending would fall because of higher interest rates. So the government starts borrowing more money, raises interest rates, and then there's leftover for private borrowing. So it's like we got a certain amount of money available in savings, and if the government starts taking more, then there's less left over for investment spending. So is there any crowding out in this model here, in this second example? Well, we do see some. There is some evidence here because real interest rates are increasing. So real interest rates are going up and investment spending is going down. So this model does show some crowding out. So this model showed some crowding out. Private investments. Now, there's a big debate about how much crowding out there is. Does it exist or does it not exist? You think it would have been all solved by now, 70 years or so after Keynes came up with his ideas, but it really hasn't. If there was a lot of crowding out, it would mean that government spending wouldn't have a big impact on real output in the short run. That means that fiscal policy would be somewhat ineffective if there really was a lot of crowding out, because when G went up, then I would fall just as much and real output wouldn't change in the short run. Keynes thought that crowding out would be very small. His followers also think that crowding out is pretty small. The people who don't like Keynesian ideas think that the crowding out is very large. Remember, Keynes was thinking we have a recession, and for the most part, it's because there's a lack of aggregate demand in the economy, probably in the investment category, probably due more to animal spirits than interest rates. So if that's the case, nobody wants to start investing or spending money on investment products. The interest rates might not have that big of an effect. So if the government starts spending a whole lot and raising interest rates, may not have a big effect on investment spending. That's what Keynes was thinking. Okay, so that concludes this video on our examples that we did. The only last topic is an open economy. Now we can use this model for an open economy where we extend it to trade. And the results are that we still get an equilibrium where savings is equal to investment. The difference is by net exports. So we have the difference between savings and investment is net exports, which are exports minus imports. So what it means is that if savings is less than investment in the economy, then foreigners are providing the savings. Are providing the savings. So that savings and investment will be equal. And the other way around, savings is greater than investment, then this country is providing the savings to other countries. Now, this difference in exports minus imports, net exports, is the trade balance. So we can look at the trade surplus or the trade balance, trade surplus or the trade balance, trade deficit, to make up the difference between domestic savings and investment. Okay, so what we've done in these videos is we've gone through the savings and investment model. We've got a savings function and an investment function. And down here is the quantity of savings and investment. And what we did is show this model that was around before Keynes. The model they had really isn't sufficient. Keynes said it just won't work in the short run. Keynes revamped savings, and what savings is a function of. It's not just a function of interest rates like they thought. It's a function of mainly of income. And investment is a function of more than just income or interest rates. It's also a function of animal spirits. We can use this model if we just make it a long run model where output can't change, where output is always at potential, which is our long run equilibrium. So this model gives us results for what's going to happen in equilibrium in the long run to changes that happen. We've got 5 exogenous variables, and we've got 4 endogenous variables. One of the exogenous variables is income, but we hold that constant at potential income.